Thanks so much for joining us on the Fractional Analyst today. I wanted to walk through a development project, specifically a garden-style multifamily development project. This particular project that we're looking at here, it's 135 units, average size 861 square feet per unit. Total square footage 116,300, split across 5 buildings, again 135 units. Looking at doing it on about 6 acres. So that's an average density of about 22.5 units per acre. Some general assumptions about the project based on the submarket. General vacancy of about 6%, credit loss of about 2%, rent inflation of 2.5%, expense inflation of 2.5%. These are all per year. These numbers are on a stabilized basis taken out of income, absorption of about 20 move-ins per month once we deliver those buildings. So project milestones here, land close, start site work, go vertical, finish construction, and start leasing, which, by the way, is more conservative, specifically with this type of product, garden style. You've usually got a few buildings, and those buildings typically deliver is sequentially. So they're not going to just deliver all 5 at the same time. But this model assumes that those buildings have to finish construction before you're able to start leasing. So there's some upside there that's not included in the analysis. So backing up for just a second, you can certainly get very granular with the type of modeling that you're doing, right? You could align this to more of the reality that these buildings are going to deliver sequentially and you're going to be able to realize income faster. And that's all well and good. But if you've ever worked in real estate development before, you know that delays arise, things happen. So it's much more important, in my view, to build in buffer into your investment returns rather than getting those more closely aligned with the expected reality because of things like that, right? Construction delays happen. You start leasing and certain residents decide they want to lease elsewhere, right? They leave, you don't hit your absorption targets like you thought you were going to, et cetera, et cetera. So this is one thing that I do to build in built-in opportunities to outperform into my modeling. So finish construction, start leasing. This is the occupancy at which your cash flow from operations are now covering your expenses before debt. And then this is the occupancy threshold at which your cash flow from operations is now covering expenses and debt service. And then we stabilize in month 25 at 94%, right back to that general vacancy factor, 1 minus 6%, 94%, that's your stabilized occupancy. And then we're assuming that we're going to hold this for a 5-year hold. So that's like general project milestones. This model can also build in retail inputs, but for now, we're assuming that we're not doing a retail project, so we just zeroed this out. Disposition summary shows a high level of the disposition assumption based on our income at disposition, a recalculated, what do I want to say, a fully reassessed tax burden, right? All of that inflation, all of that is built into our forward 12 net operating income at the time of disposition. And then we use a cap rate on that. We get to gross sales proceeds of 242 per unit. We have some disposition costs in here. So net sales proceeds, total project costs remaining. Why this says remaining is this model, the way that I've built it, you can condo out units prior to the final disposition month. And so if you want to look at a scenario where you're building 5 buildings, maybe you want to sell one of those buildings off, you can do that. And so it takes that building's income offline through the analysis period, and it generates an early sale value for the particular units that you specify. So then here you've got the project costs remaining, gross sales proceeds, if you did choose to condo it off, would be the gross sales proceeds of the remaining units, et cetera, et cetera. Coming up here, you've got development budget summary. So you've got land funding and closing costs, hard costs and a breakdown, soft costs and a breakdown, and then total project costs. Project returns. So this breaks it up between the project level, the general partner, and the limited partners. This is a cap rate sensitivity summary. So the way that I like to model is I like to underwrite to sort of I guess like the 20th percentile worst case scenario. I don't want to necessarily underwrite to the worst case scenario. because I want to see in the analysis, if things did go a little bit worse than expected, what could happen from a capital market standpoint. But I don't like to underwrite to middle of the road. I definitely don't like to underwrite to best case. So I underwrite to sort of the the 20th percent worst case scenario, and then I do some sensitivity, right? So what if cap rates increased by 25 basis points relative to what I expect? What would happen, right? So your returns go from a 12.1 down to a 10.5 or so. This model has a lot of iterative calculations built into it, so sometimes you have to recalculate a couple times. But yeah, that's what would happen if cap rates went up 1/4% relative to what I expect. What if they went down 1/4% relative to what I expect? What would happen to our IRR, our gross sales numbers, our equity multiple, and all of this? This gives you an easy way to see that. Some people like to use data tables, to look at a bunch of different information. A data table can be a great way to do that. But from what I found, this is a way that doesn't bog down the model, and it gives you, a way to look at several pieces of data at the same time. So if you have a suggestion on, how to do this better, I'm always open to more suggestions. But this is kind of the quickest and best way that I found to do it. So again, coming down 25 basis points. Compressing that cap rate 25 basis points each time, you get a look at, okay, well, what could happen if the situation improves. So then what I do is, I come in here, and I value paste. So what that is it's, I'm on a Windows, don't quote me on a Mac, but on a Windows, it's Control-Alt-V, and then V again to get to values. And then you value paste what you're trying to do. So you go up and you do that on each line. Give me a second here. And kind of get it all the way through. And this little guy hadn't been reformatted from what I was looking at before. I'll just reformat it real quick. There you go. You have a little sensitivity table. Oh, let's change the base case back. Yeah, a little sensitivity table that shows you, let's recalculate here, that shows you, based on capital market situation, if we sold for a more compressed cap rate, where would our returns be? We sold for a little bit more of a decompressed cap rate, where our returns would be. But this is sort of where we expect to shake out, and then everything else is upside. Underwriting in this way really mitigates your risk as a real estate investor. If you're, being a little bit more aggressive on the base case on the cap rate situation, then you have more downside that could actually be achieved in your modeling. Whereas if you underwrite this way, that there's limited downside and much more upside that could be captured. Then you're protecting yourself and your investors in a much better way. So, this is a high-level summary of a prospective deal. What would I say about this particular project just from generally looking at it? Like, what feels realistic and what doesn't? Well, this particular project is not in any one area. It's just an example project. I've worked on projects in the Orlando MSA. I've worked on them, on the east coast of Florida. I've worked on them in DFW, in Salt Lake City, in a bunch of different markets around the U.S. So you have to, you have to remember that every market is a little bit different. But generally speaking, if I was to go in here, I would say that the general vacancy and credit loss does feel good. Rent inflation and expense inflation, a lot of people will underwrite, 3 to 4%. So I like to come in under that. That feels good. Absorption at 20, that feels really good. A lot of groups will underwrite 30, 40, 50 move-ins per month. So I like to keep that move-in pace a little bit more conservative. Current rent asking versus current rent effective, stabilized rent asking versus stabilized rent effective. You're not always going to see this in a lot of models, but I like to break this out. And what this essentially is this is the rent per unit per month or per square foot during the lease-up period. And this effective rent takes out concessions. So oftentimes during a lease-up, when you've got 135 units to lease up and zero income coming in at the beginning, most developers will give away a month free or give away 2 months free or some kind of leasing incentive to get people to come in the door and to get people excited about living in the community and maybe transitioning away from another apartment community. people don't like to double up on rent. So if they can get a month free or 2 months free or whatnot, it encourages them to sign a 12 to 16 month lease. And so, this is really your effective rent during the lease up period. During the stabilized period, once you get to the stabilization number, what is your rent going to be? And then this effective rent down here is, assuming that we're still going to hold some concessions on the go forward, just to ensure that one, from a pro forma perspective, we're covered, right? We're not over projecting our effective income. And two, once we actually get into that period, if we don't have to offer concessions, then again, that's just upside. And this effective rent, the stabilized rent, is what actually impacts the valuation. This flows directly down to NOI, right? So if you don't have stabilized concessions in here, then it's going to pull your top line asking number, which is fine. If you really do believe that there'll be a lack of supply in the market at that time, and there's not going to be any concessions, then there's no need for concessions. But oftentimes, there's always some kind of leasing specials going on, so it's good to just assume some concessions as a good general practice. So that is high level, this basic development project for today. The other kind of forensics that I would do on a project like this, like a garden style apartment, is I would come in and I would look at the development budget summary. If someone's got land under contract, for multifamily for 11 grand a unit, then that's a lights out project. I haven't seen anything like that. Usually this is 25K a unit all the way to 75K a unit. So this would be really cheap dirt. That could be good, could be bad. If it's really cheap dirt, maybe it means it's in a bad location. So that would be something to look at. As far as hard costs go, these hard costs look okay. Maybe for this size of community, these might be a little skinny, but just something to confirm with the general contractor. Soft costs, development fees look normal. Municipal fees look okay. A&E is maybe a little low. Marketing for the size of community is probably okay. And then coupled with pre-leasing, all that looks fine. Yeah, so the development budget generally looks okay. The hard costs may be low, but if a general contractor is given that bid and it's a GMAX contract or there's significant cost sharing on overruns, then that would be great. And then this land is something that I would probably dig into and just verify that it's an area that you want to be in, that you want to invest in. Otherwise, that leads me to, I guess, the general point of doing this video, is that, even with these pretty low cost, these pretty low project costs and, generally reasonable income assumptions, that these project returns are pretty skinny for a development project. We're getting to a 1.6 or so project multiple over a 5-year period. We've tried to be pretty conservative on our cap rate assumptions, so there's some upside built in there that could be achieved, but this is a very real scenario that could happen. If I was looking at a project like this, it would just really, really have to depend on the market that it's in. If it's in a market that I really believed in and I just thought the developer was being overly conservative, on their assumptions, I might go back to him and say, like, hey, look, you've underwritten this really conservatively, and I appreciate that, but I believe in this project, and I do think that you could actually be at a 5.25 cap, get to 1.9 at the project level, and maybe me as an LP, that means like a 1.7 or something. After you promote and carried interest and sponsor fees. So that's good enough for me over a 5-year, and then I invest in that project, assuming that a bunch of other things checked out. But yeah, I guess generally speaking, if a sponsor comes to you and you have a feeling when you get their underwriting package that they're being conservative, based on the market and based on your research that you've done there, like, that's a pretty good indication that might be someone that you want to partner up with. Oftentimes, when investors get underwriting and investment packages from deal sponsors, the assumptions are overly aggressive, and then something that's projected at a 20 or 25% IRR ends up being a 2 or a 5 or something, and it doesn't perform. So you get conservative underwriting like this, and it says 12% project level returns at a 6% cap rate. well, the same the same deal could go to a different sponsor and they could quote you at a 5% cap rate, and it's a 20 IRR. So it's important, even if the project level returns in the underwriting come in low, to really do your own diligence and to ask the sponsor questions, and to really research the market, because this project could actually hit it out of the park, and the sponsor is just more focused on preserving investor capital than growth, but they might have found the diamond in the rough. So those are some of the things that I would look out for when digging into a sponsor's underwriting, and some of the things that I would do if I was preparing an investment deck. So thanks so much for joining me today, as we were digging into this example development project. If you have any questions about this particular example, or you have a project that needs to be underwritten, you have need of a fractional analyst, feel free to reach out. Always happy to have those conversations. But otherwise, I'll see you on the next one.